Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that remains on this run, on this bull run here that we've been on since really the 17th of June here. We've had a 14% move higher on the S&P 500. Did that mark the bottom in the S&P 500, or is there much more to go? We're going to be taking a deep look at what's going on underneath the surface in terms of the macro. We're going to take a look at the bond market, oil, and how these things are currently impacting the market and what that tells us about the risk reward on the S&P 500. But before we get into the more technical aspects of the current macro environment and try and understand what the picture looks like over the next few months, 6 to 12 months, that really is what our time horizon is based off and what our model portfolio on gameoftrades.net is based on. But if we zoom out and take a look at the longer term picture on the stock market, if we zoom out on this chart to 1940 and we take a look at the S&P at 10-year annualized returns. Now there's a big saying in the market that when you have 10 good years, it's often followed by 10 bad ones, right? And this is exactly what this chart illustrates, that when you've had a period of underperformance where the 10-year returns have been extremely low, right? For example, 1940, extremely low 10-year returns leading up to 1940, or 1973, or 2009. These represent exceptional opportunities to enter the market. And I can quickly show you that by taking a look at this chart of the Dow Jones. 1940 was around here. Now it wasn't the bottom of the stock market, but look at what followed a secular bull run here. Then we take a look at 1973 right here. Look at what followed a secular bull run. And then fast forward to 2009 here. Look at what followed a secular bull run. So this chart here really illustrates that longer term investing is really based on those 10-year cycles. And look at where we currently are. We're at the upper range of that 10-year cycle. So those investors that suggest the idea that we're only just beginning this massive secular bull run and that post-COVID boom is going to lead us into a 10-20-year bull run as millennials enter the market, that is complete fantasy. 10-year forward returns, we've demonstrated this many times on this channel and on our website at gameoftrades.net. 10-year returns don't look very attractive for stocks. But looking out 6 to 12 months, looking out to the end of 2022 and potentially the beginning of 2023, we've been very optimistic. We actually don't think that this bull run that we've been in since 2009 has yet come to an end. That this has been a correction and that we're moving out of this correction as the massive inflation that we've seen is going to start to subsist. The rising yields that we've seen bring down the market throughout this period are going to start to reverse, and that's going to give a lot more breathing room for the market to resume higher. And that's our time horizon when it comes to our calls, our convictions on the market. That's just how our research and investment process works. We're trying to capture the bigger moves in the market, whether those are big trends to the downside or larger moves up in the market. We're trying to understand what environment we're moving into. In fact, if we quickly take a look at what's been happening on the S&P 500, at why this rally is occurring, we take a look at, let's say, the 2-year yield, the 2-year bond yield, which was a massive drag on the market throughout this period, throughout the beginning of 2022. You can see the 2-year peaked right here on the 14th of June, and the market bottomed on the 17th of June. You can see this is what's driving the market, yields. This is what the bullish narrative is about. And, we've been talking about that for quite some time, but there is still lots of work to do, right? And that's exactly what we're going to talk about. We're going to take a look at these things and discuss how we're currently viewing the market, how we're approaching this type of market environment. And I want to quickly begin by showing you this chart here. And this is actually a chart that was posted on an article here on June 17th, 2022 on our website at gameoftrades.net. This is an article that was called "The Stock Market Has Priced in a Major Contraction Before It Has Even Happened." And what the chart essentially showed here And this is very important to understand what's currently happening on the S&P 500. This chart showed the year-over-year change on the S&P 500, right? So the S&P 500 performance that was collapsing against the PMI. And you can see since 2000, we've had this perfect relationship, and the manufacturing PMI, so economic activity, they follow each other. So if economic activity declines, the S&P 500 is going to be weaker, right? And this is '08, economic activity collapsed, the S&P 500 collapsed. And you can see what was happening here on June 17th, 2022 is we had this collapse in the market while the PMI, so the economy, was holding up still okay. So in other words, the S&P 500, the equity markets were anticipating and were pricing in the economic deceleration that was going to come, right? So it was priced in, and we wrote it here. A huge part of the economic deceleration that will likely be coming over the next few months is already very much priced into the S&P 500. And so that limits how much more downside we can see and does leave room for the market to readjust its views, right? And that's especially if some of the tight conditions that we've had over the last few months, like elevated yields and high oil prices, are relieved. And let's see what's been happening, let's say, to the 10-year yield and to crude oil since June. Both of them have been moving down here. Both oil and yields have been moving down pretty steadily, and the market has been picking up speed to the upside. That makes you really understand what's at play here, what's driving the equity markets. Now, quickly going back to this article, because I really think this article just still applies so much to today, because here we wrote, we would need to see even further tightening of financial conditions for the markets to price in further economic deceleration. That still very much applies today. If we see oil bounce here, it really needs to break out above this downtrend line, but if we see oil break out and start to run up here, you could guess that yields would start to move back up as well. And so the stock market that's been front running these easing of financial conditions, lower yields, lower oil, potentially even a Fed pivot, that would be retraced. That's what could trigger a pullback. Now, this is not a prediction. I want to be very clear about this. In my opinion, is what's going to determine the difference between a V-shaped recovery and a bottoming process. Our research at gameoftrades.net, if you've been a member, we've posted a huge number of articles regarding the macro environment and where we think oil and yields are likely to go. We think the risk reward is still to the downside, and we expect yields to continue stabilizing and moving lower as we see a slowing economy, as we see the effects of the financial tightening that we had throughout 2021. We see all of that appear in the economy, lead economic numbers down, and so that would be good for the market. But whether the path is a straight line down or if we zigzag a little bit before moving down, that's what could make the difference between the S&P 500 doing a bottoming process, perhaps even retesting or undercutting the low, or if we see a very rapid easing of financial conditions and the Fed pivots a lot faster than what the market is anticipating, then you'd see a V-shaped recovery, and that would look a lot more like 2018, where you can take a look at yields and they just went down in a straight line, and that created this V-shaped recovery, where as you had weaker and weaker economic data, you had a stronger and stronger stock market. And that's also something we covered right here, because 2019 is a beautiful example of that, where you can see here, and it's perhaps less clear than what's going on today, but this is the stock market. So the stock market collapsed towards the end of 2018, while the PMI was still elevated. So similar to June 17th, here we had a collapse in the market that was front running the collapse in the economy, which isn't always the case, right? Sometimes they go up together, sometimes the PMI leads, but in these two cases, the S&P 500 front run the economy. And I write here, the markets were already looking forward to the recovery from the deceleration before the deceleration was even complete. And that's what's happening today, and that's why people are confused regarding why the market is up. And whether or not it's a V-shaped recovery, I don't care if we go back to retest the low, that's entirely possible, or if we have just a small pullback and then go straight back up to the all-time high. That's not what our goal is. I don't care what happens, because ultimately we're trying to capture the bigger moves in the market. So if we get wiped out because the market is doing a period of accumulation instead of a V-shaped recovery, then we're doing something wrong. If you're too focused on those short-term moves, you're gonna miss the bigger trends. I think there's way too many people watching these videos that are expecting our calls to play out day to day and for the market to just do what we said in the video the next day. That's not how it works. That's not how the market works. I always like to say in the near term, the market could go up, it could go down, it could go sideways, it could go backwards. I don't care, right? It doesn't matter to me, because ultimately I know what the risk reward is. And the risk reward is that we're aiming for a target that's a lot higher, with the S&P 500 with very, very attractive support levels just under. So if you're leveraging up to the point where you're wiped out, if the market retests the low, then you're not going to last very long as an investor. You're not going to be very successful as an investor. At least that's my opinion. That's the way I like to look at the market. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.